The IUL can be a powerful component of a balanced, comprehensive approach to tax-free retirement, but when utilized improperly, it can be a real albatross around your neck in retirement. In today's video, I'll show you how to avoid all these pitfalls so that you can get the most out of your IUL policy. The first mistake people make is they get an IUL through the wrong company. As you probably suspect, not all IUL carriers are created equal. Here are a couple of things you should look out for. First, your IUL carrier should have a Comdex rating of at least 90. That puts it in the top 10% of all carriers for financial viability. You need a company that will be able to honor their guarantees. Guarantees are only as strong as the company that's making them. Further, this company should have integrity. Do they lure you in with sky-high caps only to lower them in years 2+ once they have you in their clutches? Or do their caps remain relatively stable when economic conditions are relatively stable? Next, do they have a history of lowering their caps or participation rates based on adverse economic factors and then fail to raise them once those economic circumstances improve? If so, this is a good sign that the company may not ultimately be looking out for your best interests. The second big mistake is simply getting the wrong IUL product. You could have a strong IUL carrier that makes choices that reflect integrity and their commitment to protecting clients, but that does not guarantee that the IUL they offer is necessarily a good one. Just as not all IUL carriers are created equal, not all IUL products are created equal. Remember, IULs only work if you keep them your entire life. That's 30 to 50 years for most people. If you quit it or cash it out prior to death, you'd have been better off never having started it to begin with. You should therefore think about the IUL in the same way you thought about a potential spouse before you got married. You most likely had a laundry list of things you were looking for in a spouse. You should likewise have a laundry list of things you're looking for in an IUL, because it only really benefits you if you keep it until death do you part. Here's an abbreviated list of what you should be looking for. First, a guaranteed 0% loan. This ensures that you'll be able to take distributions in retirement that are both tax-free and cost-free. Next, you must insist upon a loan provision that charges you interest in arrears. If they charge you interest in advance, it's like adding an additional 0.4% onto your loan provision. So even though you could have a guaranteed 0% loan, if it's interest in advance, it's going to feel like a loan provision of 40 basis points. That could end up costing you hundreds of thousands of dollars over the life of the policy. Next, insist on having an overloan protection rider. This protects you in the event that through a combination of withdrawals, loans, or poor performance, that you won't lapse the policy and get a massive tax bill from the IRS somewhere down the road. With the overloan protection rider, the company reduces the death benefit to the point where the policy is essentially paid up. You'll never get that tax bill because the company guarantees that your policy will be in force when you die. And lastly, you want a policy that has a chronic illness rider. This gives you the ability to receive your death benefit in advance of your death for the purpose of paying for long-term care. Third, make sure you find the right advisor, one that understands what it means to build a balanced, comprehensive approach to tax-free retirement and who will be around for the long run. Here are some warning signs that you may not have found the right guy or gal. First, do they tout the IUL as a stock market replacement? If so, this is no bueno. The IUL is a very strong bond alternative and will improve the overall performance of your portfolio, but a stock market replacement it is not. If you replace the stock market portion of your retirement strategy with IUL, you will dramatically underperform the stock market over time and end up losing hundreds of thousands of dollars. Next, do they only discuss the IUL to the exclusion of all the other tax-free alternatives? Do they make the IUL out to be a panacea or a silver bullet, something that will cure all of your financial ills? If so, this is a good sign that they are merely a life insurance salesman and are not ultimately looking out for your best interest. At best, the IUL is a complement to all of the other tax-free strategies, not a replacement for. Okay, the fourth IUL mistake is improper funding. You could have the right carrier, the right product, and the right advisor, but if you don't fund the policy in the right way, it won't ultimately benefit you. So here's what you do. You want to get as little death benefit as the IRS requires of you, and you stuff as much money into it as the IRS allows. When structured and funded properly, your fees drop dramatically over time. In fact, if you keep the policy in force your entire life, you'll eventually get to the point where the internal costs will average about 0.5% of your cash value per year. That's less expensive than most 401k plans on the market. The fifth mistake is to make the IUL the only component of your tax-free retirement strategy. By only taking advantage of the IUL, you're not really maximizing all of the tax-free benefits within the IRS tax code. For example, you're missing out on the Roth 401k, which in most cases provides you with a company match. Folks, that's free money and will help accelerate you towards your retirement goals. You're also missing out on the Roth IRA that has liquidity features that no other Roth accounts possess. Your goal should be to have multiple streams of tax-free income, none of which show up on the IRS's radar, but all of which contribute to you being in the 0% tax bracket in retirement. By the way, if the IRS were to legislate any of these tax-free streams of income out of existence, you'd have all the other ones to buoy you up. In summary, the IUL is a long-term proposition. Beginning this lifelong commitment on the wrong foot will invariably lead to heartache and financial consequences for you and your family. So before you enter into the arrangement, make sure you found the right company, the right product, and the right advisor. Also make sure that you fund your IUL properly and make it just one of multiple prongs in your tax-free retirement strategy. If you want to learn more about how to avoid the 5 costly IUL mistakes I discussed in today's video, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head on over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally, and don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.